Okay, let's talk about something that sounds almost too good to be true. Earning real, actual yield on your digital dollars, without the insane roller coaster ride of the crypto markets. Seriously, we're going to pull back the curtain and give you the real playbook for how to do this, step by step.
It really is the biggest question, isn't it? I mean, after seeing all the collapses and the crazy volatility, you're probably thinking, is this even possible? And look, you're right to be skeptical. But the answer is a resounding yes, you absolutely can. It's just not about gambling. It's about having a smart, deliberate strategy.
So the whole idea here is actually pretty simple. You've got stablecoins, which are basically just digital dollars. And unlike the cash that's probably sitting in your bank account earning, what, 0.0 something %, these digital dollars can be put to work in the crypto economy to generate a real, steady income stream for you.
And listen, this isn't some kind of magic internet money. The yield comes from very real economic activity. A huge piece of the pie comes from people borrowing money and paying interest, and another big slice comes from traders paying fees. DeFi just cuts out the traditional banking middleman, right? Which means a lot more of those earnings can be passed directly on to you.
So, where do we start? Well, the absolute safest place to begin this journey is with something called overcollateralized lending. The easiest way to think about it, it's basically a high-yield savings account but built for the world of decentralized finance. It is designed from the ground up to be slow, steady, and secure.
And here is the secret sauce that makes this so safe. It's a concept called over-collateralization. This is the bedrock of this entire strategy. What it means is, before anyone can borrow your stablecoins, they have to lock up assets, like Ethereum, that are worth way more than the loan they're taking out. That gap, that difference, acts as this incredible safety buffer for your money.
Let me just walk you through how this safety net actually works in practice. First, you deposit your stablecoins into a lending pool. Simple. Then, a borrower comes along, posts their collateral, and takes out a loan. Now, here's the really clever part. If the value of their collateral starts to drop and gets too close to the loan amount, the system doesn't just sit and wait. An automated process called liquidation kicks in, sells their collateral on the open market, and pays you back instantly. It's an automatic protection mechanism.
And you don't have to go digging around for some obscure platform to do this. We're talking about giants like Aave, Compound, and Morpho. These have been battle-tested for years, with billions, with a B, of dollars locked in them. For instance, our friend Bob from the source material, he put $5 into a protocol just like this and earned a super simple, stress-free $225 over a year. Not bad.
But let's be real for a second. While your money is protected from someone defaulting on their loan, there is always the small risk of a smart contract hack. And that's exactly why sticking to the big, audited, long-standing protocols is absolutely non-negotiable if you want to sleep well at night.
All right, ready to move one step up the risk and reward ladder? Let's talk about liquidity pools. So, if lending is like a savings account, think of this as owning a tiny, tiny piece of a currency exchange. You're just putting your stablecoins in a pot and earning a small fee from every single trade that happens.
Now, the real magic here is using stablecoin-only pools. You might have heard about this scary thing called impermanent loss, which is a huge risk when you're dealing with volatile crypto assets. But when both coins in the pool are pegged to $1, they barely move in price against each other, and that almost completely eliminates that risk. You just get to sit back and collect the trading fees. And the potential returns here can be really attractive. We're talking pools on major platforms like Uniswap and Curve that can generate some serious yield, all depending on how much people are trading. Take Lisa from our source guide. She put $10,000 into a USDC/USDT pool and ended up with over a 12% APY after fees. I mean, that is a serious return, especially for a strategy that so cleverly avoids a lot of the usual crypto risks. But you know, there's no such thing as a free lunch. The main risks to watch out for here are transaction fees on Ethereum, which can get pretty expensive. That's why using a Layer 2 network like Arbitrum is a must. It makes your transactions way cheaper. You also have the small, but real risk that a stablecoin could briefly lose its $1 peg, and of course the ever-present risk of a smart contract bug.
Okay, so what if you're listening to all this and thinking, I do not want to deal with any of that technical stuff? Well, that brings us to centralized finance, or CeFi. The absolute best way to think about this is like a vending machine for yield. It's incredibly easy, it's convenient, but at the end of the day, you're trusting the machine to work.
And this really gets to the core trade-off, doesn't it? With CeFi, the upside is simplicity itself. You sign up, you deposit your money, and you start earning. The downside? You give up control. The platform holds your keys, which means you're trusting that their business is actually sound. This introduces two brand new risks, custodial risk and counterparty risk.
And honestly, the yields are why people take that risk. I mean, look at these numbers. We're talking double-digit APYs on platforms like Nexo and Ledn. Maria, from the guide we're looking at, put 20 grand on Nexo and was earning $2,200 a year. It's a very attractive proposition, no doubt about it.
But this slide is a critical reality check. Those high yields come with very high risks. In 2022, major CeFi platforms that looked completely invincible, I'm talking about Celsius and BlockFi, went bankrupt, and users lost everything. This is what counterparty risk looks like when it hits home.
Now, that doesn't mean all CeFi is a no-go zone, but it does mean you have to be incredibly selective. You have to do your homework. Look for platforms that offer public proof of their reserves. Make sure they have real third-party insurance, and be sure they're transparent about who they're lending to. And please, never, ever put all your eggs in one CeFi basket.
All right, so we've looked at the building blocks, right? We've got low-risk lending, medium-risk liquidity pools, and higher-risk CeFi. Now for the most important part. How do we actually put these pieces together into a smart, balanced portfolio that lets you sleep well at night?
The source guide suggests this simple three-layer cake approach. The foundation, a big 50% of your portfolio, is in that super safe, low-risk lending. The middle layer, 30%, is in stablecoin liquidity pools. And then only the top 20%, the smallest slice, goes into a couple of carefully chosen, higher-yield CeFi platforms.
So let's see what this looks like with some real numbers. If you had a $10,000 portfolio, this strategy would put 5 grand in Aave, 3,000 in a Curve pool, and the final 2,000 in Nexo. And as you can see, each one of those buckets contributes to your total earnings, creating a really nice balance of risk and reward.
And what's the result of all that? A blended APY of nearly 7%. That is a fantastic return that crushes inflation and traditional savings accounts, all while being structured to manage your risk so you don't have to stay up all night worrying.
And finally, every good plan needs an emergency exit. It's really smart to keep a small portion of your stablecoins offline in a hardware wallet, just for instant access, in case things get weird. Know your exact action plan for what to do if a stablecoin starts to wobble off its $1 peg. And remember to check in weekly, not daily. This is about steady growth, not becoming an obsessive chart watcher.
I want to leave you with a golden rule that applies to every single thing we've just talked about. This might be the most important takeaway of the day. Whether you're in DeFi or traditional finance, if a yield seems way too good to be true and you cannot clearly explain where that money is coming from, you should be very, very cautious.
You now know more about generating safe, sustainable yield than probably 99% of the market. You have the blueprint for turning your digital dollars into a productive, income-generating asset. The only question left is, what's your first move going to be?